Well, hello everyone. Welcome to After the Close. My name is Barbara Armstrong. I'm a coach and senior manager with Charles Schwab, and I am delighted that you are joining me here today. So, what is this class all about? Well, we assumed at the beginning of the year that we had come into a sum of money, and the amount we picked was $1 million. And you might say that's a little rich for my blood, or why only 1 million? You can, extrapolate the concepts that we talk about here to whatever size of portfolio is most appropriate for you. But this class is really targeted to busy people who maybe have a job or other obligations where they can't be sitting and watching what's going on in the market all day long. Maybe they don't get to sit down and look at this kind of stuff until after maybe 8 or 9 o'clock at night. And yet they want to be able to manage their investments. And, I always ask myself the question when I'm looking at investing or placing a trade, why am I doing this? Am I doing this to protect my portfolio? Am I doing it to grow the portfolio, or am I doing it to generate income? And today we're going to talk about an income generating strategy. I met someone at an event in Chicago last year. It was an in-person event, and his goal was to make $100,000 a year in income from his trading. And you can do that a number of ways. And I said, is there a particular strategy that you were planning on using? And he said, yes, he wanted to use something called a buy right covered call. And so that's what we're going to talk about today. I thought it would be a great topic. And his goal was to make 100,000 a year. So I think it's important to have a goal. And if you want to earn an income, is it 500 a week? Is it 5,000 a month? Is it, what is your goal? So his goal was about 8,000 a month or 2,000 a week. And so, we're going to look at, how many trades might one have to place using that strategy to achieve that goal. And you might want to use a number of different strategies to get there. I mean, it's totally up to you. And this is, hypothetical, and it's not a recommendation, but I thought it would be a good premise for today's class. So if you are here and brand new and here for the first time, feel free to type a greeting into the chat. I see a lot of the usual suspects, and I'm delighted to see you here. If you aren't following us on X, consider this your invitation. My handle, Barb Armstrong CS. Mike Fairborn is with us in the chat. He's a friend and fellow coach. His handle, Mike Fairborn CS. So this is an options strategy, or a strategy where you both buy the stock and sell a covered call. Know that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform, which is a great place to learn and hone your skills and become familiar with the platform before considering placing a trade in your live account. Sorry, I skipped ahead a bit. One of the nuances or differences, though, between Paper Money and a live account is that short options will never be assigned early. And if you aren't sure of what that means, not to worry. We'll walk you through all of that in today's class. If you have never been to an in-person event, the next one coming up is an advanced option workshop, and it is in Anaheim. It's a 2-day event. It'll be May 30th and 31st, a Friday, Saturday. And with this event, it is it's free to attend, but you do have to register, and these things tend to fill up quickly. So you'll want to throw your hat in the ring if you plan on attending. I will be at that event, and then at the Market Drive in New York. Kevin Horner and a cast of other illustrious people will be at the event in Miami on the 13th. So there's lots of stuff that you can attend. If you go to schwab.com/events, you'll see we've got a number of choices laid out through the end of the year. So let's go and look at the platform. We're going to do a quick overview of what's been going on in the markets. Now, at the market open at 9:30 Eastern, Kevin Horner does a class and a pretty in-depth overview of what's going on in the market. So for more detail, you can check that out in the archives. But we can see that we had this huge drawback. It put us into not just correction territory, but bear market territory. It was a pullback of over 20%, and we've now come a long way back from that bottom. And when we look at the NASDAQ, which is our tech-heavy index with no financials, we're seeing something pretty similar. In fact, this was down more like 23 or 24% and has now come again, a long way back. So, and when we look at our Dow, which is based on the price of the stock, it too, similar pattern, big drop down. And this has come like not back to an all-time high, but almost back to this previous high here. It's been a little slower on the recovery. But, when we look at this one also, today we have this bullish engulfing candle, which, some would construe to be pretty bullish. When we look at our volatility index or our fear index, we were up here in the 20s. We went as high as 60, which is almost unheard of. And we're now back under 20, saying that, there's been some confidence restored in the market. I don't know. It's been a very interesting year so far. But let's talk now about this idea of the buy, right, covered call. And we have done trades using a buy, right, covered call in this class before. But if we come and look at Travelers, and I'm going to activate this and kind of draw this line up. So what we saw is that we came up to this previous high, and we're just kind of peeking our head above. And some might say, well, you're drawing your line there. I'd rather put my line here, at the top where these, and in which case it kind of broke out and came back to retest and then is moving to the upside again. But if we were bullish on Travelers, and if we come and we look at our last earnings, the earnings estimate was 68 cents a share, and it came in at $1.91. So that's, it kind of accelerated its continued move to the upside. So if we look at this and say, well, we'd be okay with owning this stock, but this is a dating strategy. It's really not a long-term love affair. So what we're looking to do here is buy 100 shares of stock and then sell a covered call in what I refer to as the middle of the road. And what do I mean by that? Well, the idea here, if we're doing this as an income generating strategy, is to buy shares of the stock, and it's trading right now at 270. Like it closed, oops, just trying to get my drawing tool going here. It closed at 270. Come on. Okay, well now it'll draw. There we go. So we're going to look at, could we sell the 275 or the 280? And then if the trade doesn't go according to plan, could we put a stop down here below this current support level? So the idea is that we're going to sell a covered call with the expectation that the stock is going to continue to go up. And the closer we place our covered call to where it's currently trading, the higher the likelihood that we would be called out, right? Right. Okay, so let's go and look at this. So if we come to the trade tab, and, May expires tomorrow. So if we come out and we look at June, now this is not a very volatile stock. And so our premiums aren't going to be super juicy here. But if we look at this and say, well, if we have 198 contracts, we have a 28% chance of it being in the money at expiration and a 56% chance of it at least coming up and kissing the 280 in the next 36 days. And in the meantime, you know, if we wouldn't mind owning the stock, you know, this is a stock that might be appealing to some value investors with a PE ratio of 14.7. It does pay a dividend of 1.6% as well. Now, one of the differences between paper money and a live account is that dividends aren't paid in a paper money account. Dividends, there's never a guarantee that dividends are going to be continued to be paid by any company also. And this isn't really the reason we're placing this trade. We're just saying, hey, this might encourage other people to buy this stock, which might, in fact, drive the price up. So we're going to right click anywhere on this line, and we're going to come out and look at buying covered stock. And so how much could we make if, in fact, this was run over and we ended up being called out at $280 a share? Well, we could make about $12 a share, which is 280 minus 268. Actually, technically, it's 11.95. So if we look at this and we say, okay, the most we can make is 11.95 or $1,195 on 100 shares, and I divide that by the 268.05 that I'm investing, what is my return on my investment potentially? It's 4.4% for a trade that we would be in for a maximum of 36 days. Okay, so if we're okay with that now, if we wanted to put a stop in, where might we come? Well, we might come here and say, well, yesterday our low was 261.09. So I'm going to take that 261.09 and multiply that by 0.97, and that'll give me 253.26. So I'm going to put my stop down here. So we're looking at getting in here. And actually the market's closed now, so it would happen tomorrow at some point. But if we want to show this on the chart, 253.26, 253.26. Now, a lot of people like to make their stops fairly tight, but the closer your stop loss is to where the stock is currently trading, the higher the probability that you could get stopped out. Okay, so we're going to look at our stop loss here, which is 3% below this level. And so how much are we risking to the downside? Well, $15 a share or $1,500 for the opportunity to make about 1,100 or 1,200. And so some might say, well, that stop is too low. And you are welcome to move that stop up. But if we take a look at this and we look at a stop in that neighborhood of 250, and these are all $10 wide, there's only a 13%, our delta is 13, which gives us a probability of 14% of it being in the money and 28% that it could come down and nick that stop. If we put the stop $10 higher around 260, $10 below where it closed, now you have a 56% chance of being stopped out. And so you don't want to lose money, but you also don't want to get nicked out and then have it go up. Okay? Have the stock go back up, and then you're out of the trade for a loss. So if we put this in, we're going to take our single order, and it brings up a little drop-down menu. You're going to pick first trigger sequence, right-click, create an opposite order, and we're going to put our stop in. We're going to put it in as a market order because we don't know exactly what the price of this call is going to be. So we're just going to say, hey, if we get to the point where the stock goes, oh, dang it. I don't know why I'm having this problem. I had to reboot my system earlier. So I will put this in after the class. For some reason, it's not letting me bring up my drop-down menu. I haven't had this problem for a while. Okay. Sorry, guys, I'm having a technical problem here. Okay. Where's trigger sequence? Let me try that again. I've done several of this exact same trade this week, so it's a little weird that it's not playing nicely here. Market, good till canceled. It's not coming up for me. Okay, so what I'm going to do is we're going to put these trades in and I'll put the exits in tomorrow. Okay. Yeah, I'm just looking at the questions. So let's just go ahead and we'll tee this up to go in, and then I'll answer some of the questions. So we're going to get rid of that. Well, on the trade tab. Okay. We're going to delete all of this. So today's, it would just have to be the day where my system does not want to play nicely. So we're just going to go and tee this up to go in tomorrow, and then I'll show you how to add those exits next week. And we're going to put that in our buy right covered call group. Okay. Switch today, change it after the condition. I don't know if that's... somebody's asking about the power of compounding. And the power of compounding is really powerful. And I have two short videos that if you haven't seen them, I'd highly recommend that you check them out. And they're on the Trader Talks channel. And, you know, when you first come to this, and if you haven't hit the subscribe button, you're going to want to hit the subscribe button in the bottom right corner. And when it first comes up, you'll see whatever's currently playing. But if you come to playlists and then come down here to trade management mini sessions and click on the full playlist, there's two short videos here on the power of compounding, and the power of automating that is kind of the second one. And if you look at it and think, like, if you can just start and grow your account by 10% a year, or like the average of the S&P and the NASDAQ combined is about 12% a year over the last 30 years, it has a very powerful effect. And I'm about to record a short video on a stock that we have done multiple trades on. And I haven't done the math on it yet, but I'm assuming most of them were positive experiences, and just how that can, you know, all those little base hits doing short verticals and long verticals can add up, and all of a sudden it starts to look like and smell like real money. And that, when it's done, and I'm going to do that tomorrow afternoon, it will be at the very top of this orange group. And then you've got some example trading plans here. Somebody had said they had just done their first short call vertical or short put vertical. Here's an example trading plan for each of these. Here's one for a buy right. Okay, let's go and look at another example, and let's hope this time I have a little more luck. It's odd because I just rebooted my system because things were running a little slow. So, I don't know what happened. Okay, so this is Rivian. If you're not familiar with this company, if you come to the Analyze tab, we can see that it's a car company. Okay, it's based in California. It's based in Irvine, California. And, when we look at the chart here, we can see that we had this kind of double bottom pattern that set up. And then it broke to the upside, came back to retest, and is moving on up. And if you look at this, you might say, well, I'm not sure I want to be invested in this for the long term. But if you think it might continue up for the next 3 weeks or 6 weeks, could we come out and even sell like the 16? Sell a covered call around 16. And, it's at 15.30. And you're saying, well, how much would you make? Like only 70 cents a share in the stock appreciation. But this is a $16 stock. So if you can make 70 cents and you divide that by 15.30, just that would be a 4.5% return if it went up to $16. And then if you were paid to sell your shares at $16 and you got paid another 79 or 80 cents, what might that look like? Well, so we're again coming to buy covered stock. We're looking at selling the 16 call. So what's the most we can make? Is 16 minus 14.52 or $1.48? Well, my spidey sense tells me that that's about a 10% return, because if we could make $1.48 on 100 shares, or on a share, which is $148 on 100, and I divide that by 14.52, which is what we're paying to get in, that's a 10.2% return. For a trade we might be in for 36 days. Well, what if it goes up to $17? You're going to be called out at 16. And, if you're at a barbecue and you're saying to somebody like, can you believe like this stock went up to 17, but I sold a call, which means I obligated myself to sell it at $16. So I only made 10% in 36 days. That's not a bad return. And if you're saying to yourself, you know what, I think it's going to continue to go up. So I don't want to, I don't want to place the trade, then don't sell the call, just buy the stock. But if you were looking to generate income, and if you go back to somebody saying, hey, I would like to generate $100,000 a year, so I want to make $8,000 a month or net $2,000 a week. So I want to be continually placing strategies. Now, this account has $1 million in it. So if we said, well, one trade, we would be okay with investing up to 5% of the account value, or 50,000. So if we said, okay, we're willing to invest up to 50,000 with a share that's $14.52 a share, how many shares could I buy? So if I took that 14.52 is our net price to get in. Okay, that's got to be wrong. 50,000. I must have had 5,000 divided by $14.52. Yeah, 3,443 shares. Well, if we bought 1,000 shares, that would be 14,000. So we could buy 3,000 shares. And you might say, well, I'm not comfortable buying 3,000 shares of Rivian just because your position size can be that high. You could say, like, I'd be comfortable just buying 1,000 shares. And how much are we risking? Well, if we're going to put in an exit, where might that be? So we could make 1,480. Or if you said, I'd be willing to buy 2,000 shares, that would be a $28,000 investment. So we could make this 2,000. And where would we put our stop? Well, we might say, I'm going to put it below this low of yesterday, at 1422. And you'll notice the premiums are much richer on this because the volatility is much higher. And so if we put our stop at 1422 and we did 3% less, that would be 1379. So then how much are we risking if we did 2,000 shares? Well, if we buy the stock for 1450, because position sizing and how much we risk is important. So if we buy it for 1452, and if we get stopped out for 1379, and there's no guarantee we get out at exactly that price. Sorry, I didn't get my decimal in there. 14. This thing is my nemesis. 1452 minus 1379. So we're risking 73 cents a contract times, or a share, not per contract, per share, times 2,000 shares. So we're risking $1,460. Well, in this class, we're okay with risking up to 5,000. And so we will put in our stop tomorrow and exit at that 1379. And for today, we're going to just enter this trade. And so, with this, our max profit would be 2,960. So if this goes according to plan, that could be a nice arrow in our monthly quiver. If we did 3 of those trades, we'd have exceeded our target. You can do a buy stop entry or a conditional entry. In this case, we have an entry. It did go up today. But if we look at, say, Uber, and this was going to be our third example. So Uber's been uptrending, and when we kind of back things up and we look a little further out in time, we could see that, it had this big double bottom pattern, and then it broke out and came back to retest. But this stock is up 48% so far this year. And then it went up, it hit a high on Wednesday and has been pulling back. So you might say, hey, today it hit a high of 91.11. And so I'm going to say if it goes above that 91.11 by 20 cents, so if it hits 91.31, I'd like to buy some shares, and then I'm going to sell the 95 covered call. And so if we look at this 95 covered call, we get about $2 for it. So if we were to do it now, by the time we sell it, we'll get more in all likelihood, depending on if we get in tomorrow or next week, but we might end up getting more because we're looking at selling that covered call when the stock is higher in price than it is now. And we might just say, you know what, we're going to make this a market order. We're willing to get in, and whatever the going rate is, this is very heavily traded. It traded 20 million shares today. There are 20,000 contracts, on the books, 1,200 contracts traded today at the 95 strike. So, and I don't know if this will come up. This isn't working. So I usually bring up a conditional order. And now let's if I make that a day order. Somebody said that might help. It's not helping. Dang it. So I can't show you that way of doing it. But when you bring up that conditional order, it just says only enter this trade if and only if it goes above 91.31. Yeah, so a covered call. So let's kind of walk through. So I will put this one on in the morning once I have figured out what is going on with my system. I'm sorry, like I've been placing these trades all week. This is kind of bizarre. But so let's say we do this covered call at 95. Okay, so, and this is, we're calling this a buy right because we're both buying the stock and we're selling a covered call at the same time. So it's a buy right covered call. And this would be expiring June 20th. We're going to show that on the right. And we'll come in a little tighter. So if we, our expectation is that this might well be up above $95 by June 20th. So if that happens, then, what do we do? Well, if at expiration, it has gone up and it is trading above the 95 and we do not buy this call back, the probability is very high that we would be called out. We would have our max gain, but we would no longer own the stock. Are we sad about that? No, we did this as a short-term, we did this as a short-term trade. So this was a dating strategy. We weren't intending. So as far as we're concerned, this is a really great outcome. Now, what could be an even better outcome is if we had another couple of days like these 2 days right here, where we had like a really big up day and then another big up day. And then we could be called out at any time, regardless of how far it is in the money and regardless of whether it even is in the money. But if we got called out, let's say it went up to 100 and we had sold this 95 call and we get called out on Monday. Well, we're going to be thrilled with that, result because we were hoping, it was our goal to make that in 36 days. And if we made it in 5 or 6, like Bob's your uncle, like we would be thrilled. Now, have I ever seen that happen? Yes. Have I seen it happen often? No. And can this be trading in the money and you not be called out? Yeah, I see it happen all the time. So what else could happen? Well, it could go up past our strike and then it could come back down. And let's say this is expiration and it's now trading at $94. So, it's now trading at 94. It's below our 95 strike. And so it would expire worthless if we didn't buy it back. So, what we could do is just say, okay, you know what? This has now, it's pulled back. I'm going to buy back this call. And let's say I got paid $3 for the call. Maybe I could buy it back for 40 cents or 30 cents even. And so I've made some money on the call and then I could come out and now it's trading at 94 instead of 90. Maybe instead of selling the 95 call, I could sell the 100 call and get paid $3 for that. And then if I am, called out on this next round, the next time, I get called out at 100. Well, when I bought the stock originally, I was willing to sell it at 95. So am I sad if I get called out at 100, even if it went up to 105? No, going to be doing the happy dance. Now you're saying, okay, these are both bullish examples, and you are correct. Now, what if we get to door number 3, which is the not so happy door, where were we putting our stop on this one? I don't think we calculated it. But let's say we were putting our stop here at 89, just as an example. Well, it would probably be lower than that. You know, so let's just say we had our stop at 89, and it comes down and it nicks that 89. Well, we would be out of the trade, and we would have incurred a loss. Okay. Yeah. Yeah. And so this is where we have to kind of look and choose. And if we look at something like Rivian, which is a less expensive stock, or Affirm or SMCI, you know, which they're higher volatility and they have a lot of strikes. So let's come and look at Affirm. So Affirm pulled back today, but let's say that starts going up and we get in here. You know, the closer the strike is, so it's at 51.75. So, but it has been uptrending in spite of the fact that it pulled back today. So and volatility on this is high. Look at, it's at 67.8 versus Travelers, which was at 22.9. And so here you're looking at a strike $10 above, and they'll pay you $250 to $320. When we come and we look at Affirm, here's a $50 stock, you know, and they'll pay you $365 to $375, you know, for something that's, you know, at $52.50. Or if we sold the 55, like the probability of being called out if we sold the 52.50 is really high, a lot higher. It's 93% probability that it will come up and at least give it a smooch. It'll come up and touch it. The probability of it being in the money, 44%. And so you could say, well, I want to do that higher probability trade. I know I'm going to make less, but it's not nothing. I could still make $4.45. Like, that's got to be over 8%. If in fact that trade worked out. So if you said, okay, I could make $4.45, and I got that by taking 52.50 and subtracting, well, we're still, you know, things are still changing. It was 48.05. At 445, and I divide that by the 48.14. That's a 9.2% return. And we're, you know, looking, you know, at a higher probability of achieving that return. And really, guys, that's an extraordinary return. 9% is at the high end. So I don't want you to think that that's, you know, a typical. If we looked at a stock in the consumer staple sector. So here's Altria, which has overall been kind of uptrending here since the end of January. It's up 11% year to date, and it came up, had a bit of a spill, came up, pulled back, and today we have this big bullish candle. If we said, hey, what if we did like a swing trade? Only we don't even have to go all the way to the top. It's at 58 if we sold the call at 60. So if we sold the call at 60, we'd only make like 1%, not even 51 to 56 cents. But there's 10,000 contracts out there, so there's lots of volume. If we said, okay, if I'm buying covered stock, I could make $2.50. That's about 5%, 250. And if I'm dividing that by my investment of 57.53, that's 4.3% in 36 days. That's not too shabby. Yeah. And the probability of achieving that, given these numbers, it's over 50% that it'll come up and touch it, 25%. Now, this stock is also in that category of value stocks. This pays a dividend of 7%, which is pretty hefty. And again, no guarantees dividends will continue to be paid. And dividends aren't paid at all in paper money. But if we ended up holding on to this stock and it didn't come up to 60, or it went up and it didn't stay, and our covered call expired worthless, would we be okay in doing that again? And so, this is something that we can consider when we're looking at a strategy like this. Okay, so let me just come back and look at these questions. And I apologize for the glitchiness of my Thinkorswim platform here. Yeah, somebody's saying, hard not to think of hindsight if it went to 100, but a win is a win. You have to be cool with the return you're getting. Like, what if this came up to $62 a share? Like, your break even is the covered call, the strike you sold, plus the value, whatever you got paid on the option. So if it went up past 60.50, you would have been better not to have sold the call. You would have made more money. But by employing this strategy, you placed the trade in the first place, and you said, I am willing to place this trade. If it goes above, I'm okay with that, because then my likelihood of being called out is higher, and I'm not going to cry in my cups if it goes up to 62. I'm cool with a 4.3% return. If you're not okay with that, then don't sell the covered call. But in that case, you may not place the trade. And wouldn't it be better a 4.5% return than a whole lot of nothing? So it's a trading strategy. Okay. So guys, that's a wrap for today. We looked at Travelers, we looked at Affirm, we looked at Rivian, and we looked at Uber. I will make sure that a couple of those trades get into our platform tomorrow so that we can follow up on those in weeks to come. And yeah, if you would hit the like button, it helps move this up in the trading algorithm so more people can find this content. Hit the subscribe button, and please follow Mike and I in the land of X, Mike Fairborn CS and Barb Armstrong CS. It would be a pleasure to see you there. Thanks for joining us. It's the end of our live webcast day now, but tomorrow we've got a full day ahead, and it starts when the bell rings at 9:30 Eastern. Will be great to see you then. Take care, everyone. Bye for now.